TheoTRADE. This is Don Kaufman. It is Black Friday, November 24th, 2023. And this Black Friday, we have a spectacular offer for you here at TheoTRADE. Whether you're a member of TheoTRADE, whether you're not a member of TheoTRADE, everyone is now entitled to our Black Friday special, 1 year of TheoTRADE for $799. I'll throw up the link here and tell you exactly what this entails. TheoTRADE.com/BF799. TheoTRADE.com/B as in boy, F as in Frank, 799 is, of course, our link. Now, this Black Friday special includes everything we do here at TheoTRADE for 1 year. That is everything from the chat room, live chat room, which streams, of course, 6.5 hours a day. You're going to get access to every class, every coaching session, every single archive we've done since, well, inception of TheoTRADE in 2016, including things like inflection point spreads and Ultima, and of course, catapult trading, controlling your risk, you name it, people. We've got an archive on it. Look, this is just the classes I've done specifically here in options. And of course, you get access to text messaging, push notifications, the TheoTRADE mobile application to our portfolios. The portfolio you're presently looking at here happens to be the TheoTheta large portfolio. So all the trades, of course, we do with the TheoTheta large portfolio, the TheoTheta small portfolio. You get access to it all, okay? There is one more aspect to this. Starting here just next week, Thursday, November 30th, we are also going to provide you the Ultima Income Generator, okay, and its mastermind group. It is a 6-week mastermind group headed by none other than Brandon Chapman. So not only for $799 are we giving you a full year of TheoTRADE. By the way, that is grandfathered in. So after this year, if you wanted to sign up again for another year, okay, you can actually renew at $799 for the next year. And again, it includes everything we're doing here at TheoTRADE, including, of course, chat room and the coaching, the archives, the classes, all the different portfolios. But we're also kicking in with what? A mastermind. It's a 6-week mastermind regarding Ultima trades. That is an additional $1,000 of value. Simply click add to cart. When you are clicking add to cart and you're filling out the order form, please remember to put in there your phone number. Of course, that is going to automatically enroll you for our text messaging. You can do a single payment of $799 or 4 payments of $200. Once again, let me throw the link up here. It's TheoTRADE.com/B as in boy, F as in Frank, 799. With that, let us get to this weekend's update. To the markets we go. All right, let's start this weekend's update with just a brief review of some of today's action. Now, today, which is, of course, Black Friday, this is a half a trading session. What did the markets do? Absolutely nothing. They were massively unchanged with a side order of the Nasdaq slightly down. Nasdaq was slightly down simply because of NVIDIA. NVIDIA had some rough news on it regarding some chips they're making for export to China, possibly being delayed. Nevertheless, this thing has been impenetrable, still only down about 2% though on today's trading session. Look, we'll talk more about the Magnificent Seven here in just a moment. Let's get down to the crux though, of course, of this weekend's update. And that's, markets in the black with the economy in the red. Let me explain exactly what that means. The first thing that I want to bring up is when I talk about like markets in the black, let's just look at the spiders. And the spiders on a year to date, okay, on a percentage basis are up, let's just round it, they're up 20%. Okay, the Nasdaq, I mean, it's all Nasdaq, right? So the Nasdaq is up some 47%. But as we start to look around the markets, and again, I'm just diving right into the topic of conversation here on this weekend update, you start to look around, okay, different sectors and so forth. Other than technology, what do you really have? All right, so I like to start with, of course, financials. Financials are basically up on a 3% on a year-to-date basis. Then I usually jump over to something like energy. Okay, and I go from financials to energy because in my mind, outside of tech and the Magnificent Seven, you got financials next that are in line. Of course, you've got energy here, the XLE. XLE is massively, massively unchanged in the year. We can come over and we can take a look at healthcare. So I'm just looking at ETF versions of this. Healthcare is XLV. XLV is down 3%. And we could switch it over, look at something like consumer staples, which is XLP. XLP is down some 5%. Again, we'll keep on going on this one. So we'll go into XLU, which is, of course, the utilities, right? Whoops, swing and a miss over there. Let's go into XLU. XLU is down a whopping 11%. Winner, winner, chicken dinner to the downside, that is. Then we'll look at like materials, which is, and again, I'm just trying to prove a little bit of a point over here because it's infrequent that people just look at every sector, right? And just kind of run through them. So we're looking at XLB. If you're not familiar with XLB, it's materials. Again, it's immaterial if you ask me, but it's up only about 4.5%. And last but not least, we'll pull up XLRE, which is actually real estate, which is down some 2% year-to-date basis. Look, okay, did I hit every single sector? Nah, I didn't get in consumer discretionary and so forth. Consumer discretionary is very skewed because it's XLY. It's skewed simply because Amazon is one of the primary components in here. So I don't even bother looking at that one because it's tech. But the point that I'm trying to make over here, yes, markets are in the black. Is the economy in the red? There's really, in my mind, only one way to answer that question right now. Okay, and we're going to talk about bonds in a moment, but the one way to answer the question, when I talk about like markets in the black simply mean, look, yes, the spiders, okay, are up some 20%. And we're going to talk about what I think they are till year end. But let's put aside for a second, okay, any opinions I may have. The one thing I think that's pretty definitive right now regarding, like, again, when I say markets in the black with the economy in the red, well, why do I think that the economy might be really starting to struggle? It has a tremendous amount to do with this. Now, this is the FedWatch tool from the CME group. And the reason I'm actually bringing the FedWatch tool into the conversation is, so the Fed's going to have a December meeting. And again, I'm just going to highlight a couple of things in this front because people have looked at this kind of incessantly, but maybe you've not thought about this Fed Fund futures in terms of economic troubles on the horizon. So in the December meeting, and this is the December meeting, there's about a 95% probability of what? And so I'm going to scroll down a little bit so you guys can see everything here. Look, the current target rate right here is 525, okay, 550. And if you're not familiar with that, that's basically where Fed Fund futures are presently sitting. And this says 525, 550, 95% probability, which effectively means, look, the Fed's not going to change rates. That is the market's interpretation of the Fed, right? And we take the assumption the market's pretty effective. And again, this is not like anybody voting. This is a tradable, tangible product. We're taking Fed Fund futures, which, is tens of billions of dollars being traded in there, and we're converting them to probabilities. We look out to January, okay? And the reason we're actually going to jump over to January is because January, again, similar picture here, right? So it's about an 87% chance of holding rates steady, okay? We're not done yet. Now we're actually going to come into March. March is where things start to get a little bit more dicey at this point. March is still showing about a 68% chance, okay, of Fed Fund futures basically sitting at 525, 550. But to start to answer that question with, markets in the black with the economy possibly in the red, here's where we get all kinds of plain and total sketchy. They're actually now projecting the first rate cut as early as May in 24. Now, here's my only opinion on this one. If that's true, that means the economy is in real trouble. I mean, you think about how fast, because right now we're talking about the economy. They haven't even cooled off inflation. CPI numbers were still, they were decent. I mean, they came down, but they were decent, right? We're seeing some economic woes, like German GDP was negative over here, but push all of it aside. Doesn't matter what you think, okay? It's what this marketplace is basically saying. And what this marketplace is effectively saying, and again, with all due respect, 525, 550, Okay, that's over a 50% chance of a rate cut coming into the May expiration. I say over a 50% because there's almost a 14% chance that they're looking at like a half a basis point cut, which seems absolutely like, I'm pretty emphatic about this and I look at these a lot. Okay, I think that this is, personally kind of insane. And the economy would have to just fall completely out of bed, like stall out. We're turning around talking about rate cuts already in May. Like, people, we're already moving into December here next week. Look out at June. Look out at June, and they're saying like, "Oh, don't worry, man. It's almost all but assured. It's almost all but assured by the June." Okay, this is 525, 550. We're looking at 500, 525, 475. They're even looking at 450, 475. And that, people, okay, that is one of the reasons I'm saying, yeah, our market's in the black with the economy in the red, right? And it's actually going to bring us into a topic of conversation here in just a moment regarding, of course, the Magnificent Seven, because well, let's come back to that in just a moment. A lot to think about on that particular front, because all of a sudden when you start to look at Fed Fund futures, the Fed Fund futures in the marketplace are completely disconnected. Clearly, this is because of 7 stocks that basically rule the roost. Before I get there, let's talk about volatility. Really, last weekend I talked about how like the VIX is dead, and it's just, the VIX is a dead product. What I much prefer is to look at shorter duration volatility. In this case, we are going to jump over to the SPX, the mother of all products. Okay, and one of the things I want to bring up in the SPX, the VIX cannot see anything that has less than, again, cannot see anything that has less than 9 days remaining to expiration. But the activity that actually transpires inside of markets is all like in short duration. Yeah, it's in like, 0 DTE and so forth. But you guys start looking out. Check this out. And I'll give you just an incredible example. So coming into Monday, and Monday, of course, is November 27th. Okay. Again, behold, what are you actually seeing here? The implied volatility. I am looking at thinkorswim and its implied volatility. The implied volatility on thinkorswim is actually derived from the mid price. That's the mark of the mid, okay, between the bid and the offer. And you ask why? Okay, I was there when we actually decided that. I thought it was a great way to do it. But if you look at the money implied volatility, okay, of the calls, you are looking at 4.37%. On the puts, you're looking at about 5.77%. There's only one point to be made with this one. That is incredibly low. You cannot and will not sell options in that kind of environment in the shorter duration. That's sheer insanity at that point. There's nowhere for implied volatility to go but up. Okay, that's, again, is that an opinion piece? Yes, but if you're a retail client, you're selling options in that one, eventually you're going to take a horrendous beating. Even when you go out to like the December 1st. December 1st, of course, is all of next week, right? That encompasses, that's Friday of next week. You're only at a 7.49. Okay, the puts are trading for basically an 8.3. So for the most part, what do you have next week? The average at the money implied volatility for the entire week is close to 8%. So again, you like to look at VIX, and I know VIX, don't worry, man, VIX is still in the 12, VIX is in the 12 handle, but the implied volatility for next week is actually basically in the 8 handle, which is, again, incredibly low. So my opinion, vol has been crushed absolutely too far, and in the short duration, buy people. Be a buyer of short-term gamma right now. If you're going to use spreads, buy those spreads in the short duration. Take directional bias, swing for the fences right now, because you know what? Volatility will eventually go, okay, from an extreme low, right, and snap back. And again, stop focusing on the VIX. It's a ridiculous concept at this point, because the VIX is out here some 30 days out. It just doesn't even make sense to look at it. You got to look at the short duration of how low volatility really is, because very few people, okay, have seen vol literally this low in years, because it simply hasn't been in the shorter duration. All right. So again, opinion piece over here, volatility is far too low. Be a net buyer of the short duration options. We can still sell duration premium. When I start going out like 111, 112 days, people, there's still some meat on the bone, especially the implied volatility skew out there. When I talk about implied volatility skew in further out in of course duration, like 111 days out, we start looking at like 5 and 6 delta. There you go, you're up to 24, like 25% implied volatility. You got some rocking volatility to be able to sell 111 days out, but the short duration is as dead can be. switching it up here a little bit. A moment ago, I was actually talking about how, of course, equity volatility and index volatility is relatively dead. We were looking how the markets are in the black with the economy possibly in the red. But there's one thing that kind of is a standout a little bit. I still see quite a bit of action inside of the bond market. Even on this holiday trading session, the bonds were actually off some 28 ticks, and I don't know exactly what those bonds see, okay? But it's my inclination and my inclination alone that we may not be completely done in bonds. In that, in terms of like supply and demand, I think there's still a very odd trade that's not occurring inside of the bond market. And I'll come down to it in summation here is I think the bonds could actually still have some significant sell side activity left in them. And one of the reasons that I believe that, as I was saying, kind of in summation over here, supply and demand dynamic, the Fed the Fed is no longer on the bid in those bonds, which effectively means that the Fed is trying to diminish their balance sheet to some extent. And the Fed has actually used these bonds. They rolled into these bonds. They're just not a net buyer right now. Okay. As such, I think that still leaves the bonds vulnerable. It doesn't necessarily matter what you think about the economy, whether you think about interest rates. Okay. We are in a supply and demand dynamic inside of the bond product right now. And again, outside what we believe is going to happen economically, okay, there just may not be enough buyers in that bond market. Okay. And this could be the beginning, if you will, a little bit of roll to the downside. So again, I am still a bit of a bond bear just for the near term. I think we have to have, if you will, as I put it up here, one last hurrah in the bonds. And that hurrah, it's not going to necessarily be a positive thing. Quite the contrary, I think we're going to have one last hurrah to the downside inside of the bond market before the bonds start to fully recover to any degree, especially in the longer duration over there. I'm just not of the opinion that we fully capitulated in the bond market when we actually did see the lows down here at like the 107. Anyway, onward and upward. Okay, now back into the equity side of things. When we start to look at markets, as I brought you through a couple of the major, sector ETFs, there's one thing that really comes to mind, I think, for everybody, and that's simply, does anything actually matter other than Magnificent Seven? All right. I mean, I think it's a fair question to ask. And I think that the answer to that is absolutely not. I mean, you may not like that as a trader or an investor. Okay. And believe me, like I've gotten into it with a lot of traders recently. I think there is an incredible amount of concentration risk in here, a dangerous amount of concentration risk. And I think that that's why in the index products, okay, that volatility being inherently low in the index products. In fact, that's exactly why I covered volatility first. But that volatility being low in the index products, okay, I think it's a wonderful opportunity. I think it's an opportunity because all you're going to have is one of these major tech stocks to start to go for it to the downside. That's it, people. It'll crack the market wide open. Because does anything but the Magnificent Seven matter? Absolutely not. Absolutely not. Your entire gains in the year. I know there's always going to be one in the crowd. They're like, you're crazy, man. Look, NVIDIA's up 233%. What do you got that's got some magnitude? What do you got that's got some serious market cap behind it that's actually a driver? Well, what are we going to look at? Are we going to look at JP Morgan? Okay. All right. You got me here. Look, I know, every one of the market caps that's big enough to actually even make a dent. JP Morgan is up there, right? It's a $440 billion company. You got me. It's up some 13%. Okay. And it's one of the drivers of the marketplace. You look at something like Walmart. Okay. Walmart's $400 billion company. Okay. Is it higher? Yeah. Okay. Is it much higher? No. I mean, it's only up like 8%. Effectively, what I'm saying, let's go look at Boeing. It's not even worth looking at Boeing. It's a $133 billion company. You know them, you love them, but they don't mean anything. It's stocks. Nothing means anything right now other than the Magnificent Seven. And the problem that you're going to get in this marketplace is, I believe that we're going to have an inherently high skew. Okay. Why is the skew going to be high? For those of you that do not necessarily look at skew, the skew is let me actually switch this to a weekly so it makes a little bit more sense. The skew should be high right now. This is the out of the money puts versus the out of the money calls in the major index product. And the reason I believe that the skew is high, there's a lot of traders and investors that actually see the exact same thing I do. They're buying puts. okay, in stuff like the SPX because they recognize it's really only going to take, okay, like one Microsoft or NVIDIA. I mean, the Microsoft thing with OpenAI could have gone very sideways in a hurry last week, cracking that marketplace wide open. One warning from any one of these companies, people, and it's on in this marketplace. So I understand, traders want to go out there and want to buy some degree of out of the money puts. And I think that because those Magnificent Seven is all that matters in this marketplace, concentration risk is not a healthy thing. So the last question, of course, on here is, will the markets hold it together till year end? I don't believe we are going to hold it together to year end. Yes, I think we could still have some upside potential in the S&Ps, but the risk right now, to me, is still to the downside. A lot of this up move, and again, you listen to somebody, I'm still bearish, and I'm bearish because the Fed fund futures right now, okay, tell me something's wrong economically. Before I even see it, they tell me something's wrong. I'm bearish because you've got runaway freight trains over here like NVIDIA, which just had some pretty rough news today, and it feels unimpeded. You've got stuff like Meta that relies completely on advertising dollars, as does Google, completely on advertising dollars. Okay, Amazon, which does have a huge retail component. Okay, if there's anything wrong economically, eventually these stocks are going to feel it. There is risk to the downside, in my opinion, okay, to year end that outweighs the upside potential. I do not want to diminish the upside capacity of the marketplace capable of even cracking to the 4,700 level. But that's not that big versus some of the downside risks that continue to persist with, of course, the economy possibly heading into the red. Last thing to mention, of course, on this weekend's update here, the SPX, the mother of all products. So here is one just, to me, very astounding thing. I'm going to take you through it. So this last week of trade, we had effectively, okay, and I'm actually going to write it up here and script it for you. You had about a $48 move, right? So $48 move is what we're expecting. We hit the expected move, kind of drove along it on Wednesday here on this Friday, which is a half a day. We were just right up here towards the upper edge of that expected move. Now, time out, okay? That was only 3.5 trading days. Now, this next week of trade, what do we got? We have 5 full trading sessions. Ladies and gentlemen, yeah, you guessed it. We only have about a $46 move. Now, where's that expected move coming from? Take a quick glance at the SPX with me. We'll go all the way out here to the December 7th. Okay, apologize. We're coming to the December 1st expiration, which is exactly 7 days out. I'm already jumping forward. Anyway, the December 1st expiration, it's about a $46 move. What's absolutely shocking to me is, so wait a second. This last week, there's only 3.5 trading sessions. We moved $48. Okay. This next week has a full 5 trading sessions. Okay. And what are we expecting here? Okay. About a $46 expected move, which is shockingly low. Again, there is a lot of economic data coming out. Just take a look at the calendar. Everything from like GDP, okay, a couple of wholesale inventories over here, retail inventories. It's a cluster, just an absolute cluster of data. Maybe they'll throw a little PMI manufacturing in there, okay, construction spending. It's a party, people. And guess what? You're going to be invited to it. But it's a party with an incredibly and inherently low volatility and a very low expected move associated with that. Hands and feet inside of the vehicle, because I assure you, you're going to feel the pinch when we move $46 higher or lower. Expect, okay, some decent movement in this next week of trade. That's it for this weekend's update. Have a wonderful holiday weekend. Bye-bye.